Let's talk some tech and growth company picks with Gary Black, portfolio manager of the Future Fund Active ETF, FFND. Gary, welcome back to the show.
Good to see you again, Oliver.
Thank you. So the fund, alongside many other growth funds, had a rough month and a half, dropped about 17% off the high. But these last 3 days have been ripping, like we're back to normal. So should we have faith that the winning momentum trades are back?
Have faith. Look, we've had this tug of war between Omicron and the Fed saying there's too much inflation and they're going to cut back, and the bond market's saying, there's not too much inflation. You see 10-year treasuries at 1.5, and as you pointed out, it's been rip roaring for the growth stocks the last couple of days, led by Tesla, and I think that's going to continue into the new year. If you look at earnings for the S&P 500. They're probably going to be up another 10% next year, so about 240. And the market's still very cheap. If you look at PE of the S&P for next year, and we're already looking at next year, it's about 19.7 times. That's about a 5% earnings yield. Compare that to 1.5 Treasury. That's a 3.5 point premium. Stocks are cheap if you look at that spread, versus historic type spreads. But I think growth's still going to continue to outperform value.
These were trends that if you tried to fight them, you would lose. If you tried to short growth companies, possibly the most powerful momentum trend that this market has ever seen, with the exception maybe of some of the crazy stuff in .com. We do see, though, for stocks like Tesla now, since the Fed's language, and the timing does line up a little bit better with some of the Fed language than it does Omicron. A stock like Tesla now, lower highs, lower lows. Did they change the game when they abandoned transitory and started talking about hikes? When will we know for sure, Gary, that this is short-term and not real regime change? Can we close the book on the possibility of regime change just yet?
No, we can't close the book. But one of the things I would argue is, even though the Fed said let's not use the word transitory anymore, if you look at its forecast, their forecast for inflation comes down from 5.3 this year to 2.6 in 2022 to 2.3 in 2023. So they could say it's transitory or not transitory, but the forecast is that inflation is going to keep coming down. And so at this point, we're sticking with our growth names. Tesla's our largest position in our fund. It's over 11%. It's had a hell of a couple days because Elon has pretty much announced that he stopped selling shares, which is what killed the stock starting back in November. And it's up, a good 12, 13% in 2 days. And I think that you're going to continue to see that. And a lot of people believe that Tesla is kind of the growth barometer. It's most actively traded stock in dollars. And as Tesla goes, other growth stocks go.
Now let's talk some of the big other names in the FANG group. Really like the move here in Tesla the last couple days. Quite a story to see how the markets responded to this. But with a couple of the giants like Microsoft, Alphabet, I see in particular you like Alphabet, not sure about Microsoft. But one of the groups that suspiciously is not taking part in this bounce back are cloud stocks. Alphabet looks fine, Microsoft looks fine, but just about every other company connected to cloud is still well off their highs, many in technical bear markets. Does that catch up to these names? How long can we get Alphabet and Microsoft, these big cloud players, totally separate from the pack?
Yeah. So here's what happens when rates go up. So when the Fed starts saying they're going to taper, which just means they're going to put less quantitative easing into the market up until March. And then everybody worries they're going to raise interest rates. Those long duration growth names don't do as well because you're basically taking the cash outflows that are well into the future and you're discounting them at a higher rate. And so what's happened is the Fed started talking about tapering is people embrace the shorter duration growth stocks, to your point, the quality growth, the cheaper growth. So Apple's done well, Microsoft's done well, Google's done well. Where those normal cloud names, which are longer duration, you could put Tesla in this camp, they're not going to do as well if interest rates rise. So I think as people, look, as COVID goes away, and it's hard to say COVID's going away when you got Omicron, being very, very contagious, but COVID will go away because everybody's getting vaccinated. And as COVID goes away, a lot of this inflationary pressure you've seen over the last 6 months which is labor shortage, supply shortage, is also going to go away. And at that point, you will see the cloud stocks and the other long duration growth do well as interest rates either stay where they are, again, it's about 149, 1.5 today, or even retreat from here, which is what I think is going to happen. I do believe, I don't want to use the T word because Powell has said don't use it, but I do think inflation comes down, and I think that means interest rates will stay right about where they are, and allow the cloud and other long duration growth names to do better.
Gary, I want to make sure we hit your third pick today, and that is Hertz, one of the wildest stocks of the past year. But other than, rather compared to like GameStop or AMC, this one has held on to a good bit of its valuation levels that it got after the memification. But will we ever see a $46 price again after just the exorbitant speculation we had in this for some time? What do they need to do to live up to the hopes of the deep bulls here?
So here's what's changed with Hertz. It's now an oligopoly. It's held by private equity folks who are much more disciplined. If you look at Hertz, Avis, and Enterprise, which is privately owned, it's about 90% of the industry. And if you try to rent a car, in the last 2 or 3 months, you see it. You're paying a lot more because there's a lot more pricing discipline. That's point two. Hertz is trying to become the EV leader in car rental. So they've got this deal with Tesla where they're going to buy up to 100,000 vehicles in the next year. It'll be 20% of their fleet by the end of next year. And when you look at price per day, revenue per day, it's about 40 to 50% higher when people rent an EV versus what we call an ICE car. So Hertz is executing under new leadership. There's pricing discipline for the first time in a long time, even though this has been an oligopoly for a while. And I believe that if Hertz can get the same multiple as Avis is a little bigger, but if they can get the same multiple as Avis, the stock will be $35. Today it's $24. The other catalyst with Hertz is they're buying back about $2 billion of stock. That's about 35% of the float. And this is as of yesterday. They redeemed a preferred issue without getting into details. That allows them to move forward on their stock buyback. That could be huge.
Okay. Good stuff, Gary. We'll be looking for that shareholder-friendly activity from Hertz as a sign of comfort in their financial situation. Nice way to close out the market here. A bullish day, a bullish take. Thanks a lot, Gary. Merry Christmas and happy holidays.
Thanks. Merry Christmas, Oliver.
Absolutely. You too. Gary's a portfolio manager at the Future Fund Active ETF FFND.